What's up, everybody? Good morning. Got some movement in the market overnight. Got Powell talking in about 30 minutes. JOLTS in about 30 minutes. Wholesale trade. Crude inventory is coming out. A lot of stuff. It's going to be a day. S&P recovered. Majority of what sold off yesterday. We're back up to about the 5120 level. It's that huge pivot point we've seen last couple of days. Hit that like button. Get ready to get started here. How you guys doing? Good morning. Man, I look like I just crawled out of bed. Whew. Good morning, friends. Yep, Powell speaking a little bit. I gotta do something real quick. About branding settings. Oh, minutes till market opens. Gonna take it easy here. Branding settings. I gotta. Oh, logo, icon, logo. Oh, okay. I gotta do something for Stripe really quick. And we're off. All right, market's opening with a nice little gap up here. Resilience being positive, so we have supports. Oh, I don't have my. Let's get back from being on vacation, everybody. Welcome back to the stream. Oh, I don't have my tablet turned on. I gotta turn it on or set my computer. We'll draw with the mouse today. All right. Res greater than 0 here. See, that's the part there is what I want to see. Oh, even better. Head stretcher right here in the middle of the way. 510. Looking great. VIX is in decay pattern, looking solid. Actually, 510 might be a place along this. It's looking solid today. Okay, so we have res greater than 0 clearly and head stretcher bounce. This is an illiquidity pocket. Market's going to play through this area pretty quickly, and this is a nice little 10-point scalp. I'd love to take a head stretcher long, 510, back up to bear zone, even if it hits here, and bounces there and turns down. I'm cool with that. So I'm going to hit about a 510 long on this. It would be rare for us to lose this. Okay, so stop there, stop there. Rare. And then res less than 0. All right. So I hit that 510. How you guys doing? Don't forget to smash that like button on the stream. Welcome back, everybody, friends. Oh gosh, I look horrible. Part of my hair is even straight. I even lost my little cool little poofiness. I just literally, I'm not gonna lie, guys, I just cried in bed. Ooh. Was it a 3-day long wedding? That was fantastic. Had a wonderful time. After that, spent like a couple extra days there just visiting the friends, and then it's pretty fun. Pretty fun. I don't think I've been on a vacation like probably since maybe Disney World last year, like a year ago. Been so busy working, you know. DD bands touched over caution. Oh, yeah, let's double check that. Let's get the watch list. Look at NQ today. Yeah, market's going to move when Powell's talking. Powell's talking in about 20 something minutes. It's going to keep that in mind. Okay. Get Q's really quick. Q's decent on the bear long up. Decent hedge pressure support, 440 Q's. Similar boat here. No monitor Russell. Russell also getting solid. So everything I think solid at this hedge pressure area. So I know that pretty much the volatility is going to come from the moves. Oh yeah, D band break on Qs. You're right. Not hedge break. Sorry, I was wrong on that. So with the caution here, be careful that this isn't trying to sell off. Of course, with Powell talking, index divergence light just came on. Red meaning that you have a deviation of at least 20, and one is positive and one's negative. That is the signs for being red. That is so the conditions for being red. So be careful with the NASDAQ resilience being that far away from the S&P. This just means it's a huge amount of rolling. So you're gonna have positions rolling out of tech again, moving down into the S&P, which is positive. Now S&P is dragging down on that NASDAQ tap. This could be the end of the move. The question is, do I want to take a little scalp at 510 or not? Try to put some money in the bank. So this day, guys, this day not looking super good and hot, but about here, do I want to see a V up in there? And the answer is yeah, we'll take it. But let's get right up on hedge pressure. Oh shit, hold on. I always forget to do this. I wish I could set it as a default, but now again, I'm not going to be super greedy on this. It's in a tight little range. Again, 510 break is a loss, so I'm going to be very careful here. Let's see how close I got. And everybody, if you don't mind, do me a favor, friends. Welcome to the stream. I am Matt, CEO of Rocket Scooter. If you guys have not joined our Discord yet, please do. I'll type the link now. I'm the founder of this company. I am the creator of this trading platform you see on my screen. And I'm a live YouTuber. I do live trading. I love having you guys here every morning. I'm currently running a major deal, which I've never done before. 40% off of our lifetime package. 40% off. 20 is the best we've ever done. 40% once in a lifetime kind of thing. Check it out. Link. I'll post it up here as well. Means you get all of our platform, all of everything we ever make, all of our tools, everything we make in the future, minus your data feeds. And any trading related stuff like commissions or whatever. That just falls through hedge pressure. I'm gonna be sad. Okay, let's take it. Very rarely does it fall without an attempt at a bounce. Let's watch Qs. 40% off means you guys can join that. So, you know, your data feeds and your trading commissions and all that, you know, the small auxiliary things, that's, you'll have that. It's the only fees you'll have. But everything is free other than that. Everything we make, all of our tools, all of our stuff. I'm really happy to bring that out there. We really want people to celebrate with us as we launch our marketplace, which is beta launching now. Ooh. All right, so Papa Powell talking right here. You guys think we can get it? It's gonna be tough. Let's see if we can get the scalp from here to here. Where's it hang in there on the S&P? This is a serious one. I'm gonna put the glasses on here. How are you guys doing today? First time you've seen DD less than 90? Yeah, right now it's close to 50. Let's monitor. We got Q saving itself at hedge pressure, IWM, a hedge break to the downside. So IWM is getting racked, and IWM is at monthly, so we have to be very careful here on this guy. VIX is still looking cool. And this is all I'm looking for today. I'm not betting that this is going to turn around and rally. That's it. That is it. We already touched DD with NASDAQ. That's the problem. We have a problem is that we already completed the move and now it's random. This is that's it. I'm just looking to hit this. That's it. That's it. To go here, to break, and to go here would be rare. Very rare. Very rare. Ultra rare. Back then. JOLTS 10 a.m. Peter, JOLTS is one of the most important piece of information that's going to be coming out because the JOLTS help you forecast what's going on with the Fed. The JOLTS are what I use to predict the Fed's going to raise rates or not, or part of my analysis that makes me think about that. Let's open up JOLTS. The non-farm employment change came out this morning. That's the ADP version. Make no mistake about it, this market is bullish. Okay. A lot of people trying to short this. It's still bullish. Doesn't mean you can't sell off today. The market's still very bullish. So quickly, if you guys understand what the JOLTS are, a job opening is from the Labor and Statistics Bureau. It is a JOLT is a position that exists. Okay, so a company has a position that exists, and that role could fill within 30 days, and there's active recruitment trying to fill that role. And so, and there's no active recruiting from outside the establishment. So essentially what it is that it's a survey of recruiters being able to fill a role. So a company has a role that is trying to be filled. You have an active recruiter outside the company trying to fill it, and there is work available. So it means that when you remove all the bottlenecks, there is nothing in the way. It's not like there's a, you know, hospital in a rural town looking to hire doctors and there's just no doctors available. And then, you know, that when it can count as a JOLT. So it's kind of show the liquidity of the labor market. That's what the JOLTs kind of do. And so when the number comes down, it means the active jobs that are being recruited for are getting filled. People are getting jobs. If the number goes up, it means either lots of people are getting laid off and roles aren't being filled, or jobs are being created. It can be seen both ways. So JOLTs go hand in hand with the unemployment filings, which help you determine if people are getting laid off or people are getting their jobs or what's going on. Put them hand in hand. The Thursday numbers are where the unemployment numbers come out. So teach you how to read that. It's pretty cool. The JOLTs coming down at the same time that the Thursday numbers, which every Thursday, what comes out is the initial jobless claims. These are the filings of initial unemployment filings. So people go out and file for unemployment when they get laid off. They're in this number. Continuing jobless claims show that the people that were laid off, are they still laid off or not? What's up, Cheyenne? Good morning. Good morning, everybody. Toss some love in the stream if you don't mind. Click that like button. And like I said, we're running a 40% off our lifetime special. 40% off. Never been like this. It'll make it like $2,400 for everything Rocket Scooter. It's a full platform, and all the features that come out in the future forever, minus your data fee costs and commissions and stuff. So also $35 a month extended trial for our $200 a month package. For some reason, investing.com hates us today. All right. Market's trying to move. Resilience is still positive. We're still somewhat okay here. Come on, investing. Why you hate me? If you don't mind, give our YouTube stream a subscribe. If you haven't subscribed, please subscribe to the channel. We'd love that. Support what we do here. Building next generation AI field trading platform. Right now, we're just fighting with our browser. We're temporarily down for maintenance. Really? Really? Bear propaganda. Investing.com. Why? Investors are supposed to be like happy and bullish. Beige book at 1. Oh yeah, beige book at 1 as well. Initial, continual. Okay, there we go. Let's open up. So initial jobless claims are people that are getting laid off. So you can consider this like the layoffs, right? COVID, people got laid off, and every week over week, fewer and fewer people getting laid off. Waves of layoffs, seasonal in January, people go off. And then a couple waves of layoffs just due to the state of the economy. And then now you can see that the layoffs in general are starting to kind of subside. Like kind of had the recession hit, and then you had that kind of like weirdness in August, September last year. So right here, this is like the Fitch downgrade area back in here. You see that like initial layoffs are kind of moderate. Okay, that's great. So people aren't really kind of getting laid off any more than the average, just normal. The continued jobless claims are how many people are still laid off after that first week filing. As you see, more and more people are getting laid off and not getting their jobs back. The number is increasing. So it's hard for people to get their jobs, and we have to ask the question why. Are there jobs available? That's question number one. Maybe the jobs aren't available, and we see the JOLTS have come down, so there are fewer jobs available to be filled. So competition's high. That's one thing that can be supporting that. Let's look at the ADP non-farm payroll, which is today. The ADP number shows that the change in non-farm private employment based on the payroll data of the survey. So the ADP numbers, which is surveying all the users of their system, minus the COVID. I hate that COVID makes all the graphs look weird now. Okay. The ADP number shows that the change in new people employed is getting less and less and less and less. This is the change. There's still more people getting their jobs back, or getting more people employed month over month. So employment's going up, but the rate of employment going up is slowing down. So fewer people are going back. So it means that the unemployment, or the total employment number, is starting to taper off like this curve shape with my mouse. That's what it's showing you. And likely coming from the fact that this right here, fewer jobs are available, inflation's still high, and people are competing for salaries. Economy's good, stock market's all-time highs. So why are people still having a hard time getting their jobs back? And it's likely because there's more people looking for work than there are jobs available. Supply and demand, right? The power is in the hand of the workers. Remember after COVID, is like everything shut down and like one job is there, right? Or sorry. One worker is like, hey, I'll come back and work. I don't care about COVID. And then there's like 20 companies that needed labor, and the companies are going to be like, we'll take you. And the piece of, well, I made 100K, but they're paying me 200 over here. I want 250 from you. And everybody was like, fine, we need a worker now. And then that's why salaries went way up when we had inflation, right? So the opposite, the power is in the hands of the worker right after COVID. Right now, power is in the hand of the employer. So fewer and fewer jobs. Employers are fine. They're stocked. They're ready to go. There's more and more people unemployed. So now with fewer jobs available, it's more competitive. You're competing against more people to get the job. Your salaries are going to come down, which means inflation is going to come down. Which means the Fed is on target to seeing inflation naturally come down. And the way when JOLTS point down, continuing jobless claims point up, supply and demand means inflation is going to come down, which is CPI is going to tick down, which is good. Now, it doesn't necessarily mean that the market's going to rally really rapidly on that CPI data, but what it does mean is the Fed is not likely to raise rates. You learned something today? Peter says, I'm unemployable. Did you guys learn something today? So is the Fed likely to raise rates with inflation? With this data point showing that the wage part of inflation is coming down? Probably not, right? So it's just the supply and demand. It's the liquidity. Like when you put those together, it's the liquidity of the labor market. And that's what you learned today. I love learning here. Learning is fun. Yee. So what's neat about it is that there's so many open interpretations to this. Like for instance, it's hard to tell if you don't piece other things together. And JOLTS is a big deal. So, 10 minutes coming out. It's going to push the market one way or the other. I'm in a trade during a catalyst. It's scary. Think about it like this. This number is going up. You're like, oh, we're creating jobs. Or everyone's getting laid off. Oh yeah, it can mean that too. Shit, which one is it? Clearly, right. Let's show you how COVID can show you how the opposite's true. Okay, ready? Everybody remember COVID, right? Normal. All of a sudden, the JOLTS go way down because there's no more jobs open. Here's the thing. When you kick everybody out and you send everybody home. See, I wish I didn't draw this little thing on top of it. When you send everybody home, the job is no longer there. There's nobody actively recruiting for it, and there's not a worker available because everything's closed down. So it's no longer a JOLT. So in COVID situation, JOLTS went way down because everyone got laid off. And so the pieces that required to be a JOLT were not all there. No active recruiting for these jobs. And all of a sudden, JOLTS go way up. It's not like we created 4 million jobs. I said everything turned back on between July 20th and July 2021. Companies one by one started rolling things back on, and a mix of growing and creating the job. So when JOLTS are going up, one of these three things are all true, right? So the position exists. Well, right here, about maybe 4 months later, we're back to normal. So this is that position exists sort of thing. So between here and here, maybe about like September, we can assume that everybody that was shut down during COVID is back on. So we dipped and came right back. So all the jobs that got killed were back up and recruiting. All the three pieces were there. The recruitment was there, the worker was available, and whatever. And so between here and here, why was there an increase all the way up to 9? It's not really a real, huge deal, because there were still people laid off and not getting their job back. So the difference between here and here was the amount of people laid off. You had all the jobs open, actively being recruited, and a worker available, right? But you just have more people getting laid off during that time. Yeah, let me show you that graph. So you always look at it so many different ways. Let's look at like January 21 until May of 22. January of 21. Let's go back here. You had you had a whole second wave of layoffs, seasonal layoffs here, and initial jobless claims. The jobless claims week over week, fewer and fewer and fewer people were getting laid off, but the number of layoffs are still high. You see this, and not a lot of people are still getting laid off during 21, etc. Weird mechanics, post-COVID world. So a lot of people getting laid off is why that JOLTS shot up. And so the neat thing is you can just chew on this a million different ways and see it. So between here, remember, while fewer people were getting laid off every week than the week before, layoffs are still really high. So that's why JOLTS shot up and then tapered. So it tells a story, right? COVID, we shut everything down, open everything back up like 4 months later. And all of a sudden, people are just getting laid off week over week over week over week over week. And maybe some new jobs are getting created while people were also laid off. So then that's a double whammy to kick this number way up. Because you have more workers filling the roles, more jobs available, and fewer people in the roles. And so more recruiting. Jump to the top. And then now this is starting to taper off because of the stability of, okay, now everybody's in their active roles. And we can say this one of two ways. Either A, companies are closing jobs out and laying people off. Let's go to the jobless claims and double check that. Are companies closing jobs down and laying people off or becoming more efficient? Are we more people working from home? That's exactly what's happening. Like there's the continuing jobless claims, so more and more people can't get their jobs back. So essentially, we've saturated the available work with workers, and more people are getting laid off. Whether it's post-COVID efficiency, whether robots are doing our work, or whether companies just realized they didn't need the 3 or 4 accountants to kind of get everything going again after the COVID slump, and then all of a sudden they trimmed back down to the one they actually needed, longevity. So remember, when you're getting your business off the ground after COVID, you might overhire just to kickstart things, and now you laid people off, and those people want to get their jobs back, but they want those ridiculously high salaries that everybody has right now. It's going to have a hard time finding that job there, and that's kind of the situation we're in. So there you go. So there's the answer. So it's bad for the worker. So fewer people with jobs means less spending, which means less economic growth. But also on the Fed side of things, fewer people with jobs and fewer jobs available means that inflation is going to come down. So the Fed's not going to raise rates. And there you go. And that's how I make those forecasts. So we know the Powell's not going to talk about raising rates when he starts chatting in a couple of minutes. The more you know. Beep, beep. All right, because we got Fed talking today. Oof. So does everybody, did y'all learn something today? Feel free to subscribe to the stream. We love it. Check out the Rocket Scooter website. Pals in 2 minutes. Feel free to check out our Discord and check out our 40% off lifetime. We're excited to show you guys that. 40% off. $2,400 lifetime means you get the entire platform, all the tools, all the future tools for free forever. Just in time to celebrate launching the marketplace. Our first vendors are live. Excited. Oh, this is scary. Wait for JOLTS to come out, baby. I feel like I'm just going to click the button and close out my trade if we pop on JOLTS. Let's get financial juice up. Let's watch for the data here. Let's put it down at the bottom. I don't like the idea that we're in a hedge break situation. All right, everybody. 1 minute. Let's go. We're going to burp. My glasses up here. Don't like it. I don't like it. Come on. Come on. I don't like that. Negative pull. I don't like that divergence in the indices. That's my glasses all smudgy. That's fine. They're probably covered in sunscreen. I've had some fun in the sun. Had a couple days in the pool, which is kind of nice. Honestly, I haven't been on like a vacation or a trip in a long time. Like, it's just been all, oh, no. Ugh. No. There's that data point. Job openings way up. It's a beat. Hold on. That can just be seen as bearish. Let's read it. Hold on. 8.8 came in at 8.9. 8.86 on 8.8 read. So that ticked up slightly, which for the unemployment situation, more available jobs. This could be seen as economic growth. This particular setup, as we were talking about now that JOLTS in the last couple of days are ticking up, or last couple of prints are ticking up, the initial jobless claims are going down. Fewer people are getting laid off, which is good. And then you have the discontinual. More and more people also laid off. So the idea is that when you have more and more people kind of laid off and the JOLTS are ticking up, it could hint that there's more people getting laid off, or it could hint that jobs have been created. One of the two can be seen. So either case, it still is good for inflation. Ugh. This resilience ticked up, which is good. Hopefully we stay the course. But I don't like the hedge break. It's not a good idea. Yeah. And growth also means, as Louis said, that Fed can't cut rates. It's the other side of the coin too. I said they won't raise rates. It also means they likely won't have to cut rates either to get some of that stimulated growth. Problem with the res being positive, we can fall to half gap, and I don't like being in a position in this setup. I might just want to take it, cut it. Let's watch. Okay, so yeah, so it's like the Fed's hands are tied pretty much right now. Let's see if we get that expected move. Bounce off a half gap on Qs. Let's see if we get it. That's the bounce there. Do we support and save the S&P today? We get a bounce here. Problem is that we're possibly hedge pressure break. This is probably not good. Let's see, once the initial shock wears off, do things stabilize here? Let's watch the S&P resilience. I mean the NASDAQ here, because this is the problem. We're getting the NASDAQ stuff starting to sell. Apple, yeah, Apple breaking bear zone. Nvidia. Today, the darling Nvidia today. We open here, we're more likely to close here in the expected range than anything else. Well, we'll see if the market holds. There's some things just selling out, so I don't like it. I don't really like the setup today. Big tickers are starting to sell. Apple's one of them. Oops. Hold on, guys. I'm gonna get my breakfast here real quick. I'm right back for right back. Half got bounce. I'm looking for that to be like the one place we save this market today, but that dropped pretty quick. All right, I'm about to cut this. Who's this 15100? I'm just gonna call it. Yeah. It's gonna start being a little more volatile. Hold on. Here's a support right here. This is the last little spot we can bounce. That's it. There's nothing else from here. I'm just gonna trim one down. Yeah, this is tough. I expect it will be appropriate to reduce policy rates. We have greater confidence inflation will be sustainably below 2%. Well, JOLTS data does imply that we will likely be reducing inflation, or inflation will be reducing on its own. It's still not enough, is what he's saying. So that's kind of where Powell's chatting about right now. So here's one of the things. We have a resistance on the VIX area, 710 or 7. So if VIX is not moving through here, we need VIX down here, 7 below. QQQ bull zone bounce. That's another thing to take note of. I'm eating my breakfast. I had the camera turned off real quick. Got me some eggs, some bacon. Catalyst days are always pretty bouncy. We'll see. Pretty confident still. But problem is it's gonna be a little bit of a fight. Reds is looking great. So now what I'm expecting, this is probably going to be nasty for a little bit. I might get lucky in the hedge pressure tap. Yep, that's what we're looking for on Qs right here. It's certainly probably going to take a little more drawn on. That's what I don't like to see. Am I comfortable with 508.90? A whole almost 2 points on Qs. That's a lot. So what happens when you roll the dice on an event? The event can stir some volatility and can move around. So it's going to be like a little choppy here. Probably right up to hedge pressure. Might bring me close to even. Yep, VIX rejecting. That's what we want to see. Plus Powell's continual comments can just, he can say one thing and kick it the other way. So, oops. Decent, somewhat better, but not great. Let's check Apple on its bounce. Make sure, yeah, we want to see VIX pulling back below 7 at least. And it's not in the clear yet. Apple's just kind of looking like shit. Tesla just getting wrecked. Amazon getting wrecked. Nvid. MHP bounce. There's one. There's one decent sign. Google too. Yeah. That's just this right here. That's that divergence. People are just dumping out of all the different stocks. Let's watch the sectors really quick. Like I said, this is catalyst, markets moving. I don't feel afraid of this. But don't forget to subscribe to the stream, everybody. Follow the channel. We'd love you. That's today? No way. Even tech is going up and trading down. Everything kind of gapped up today is what this is telling you. What are the stronger sectors? Materials and utilities. Oh yeah. There's XLC dead. XLI dead. MHP break. Wow. There are some of the worst performing actors in the discretionary. Maybe the Amazon, yeah. Tesla, yeah. Tesla. This is the one thing. I don't want to trade all the way down to 86 yellow. I'm in hedge break. I should be closing. I'm going to give it like 5 more seconds to do something. Let's see if our 2024's favorite stock is going to save us today. S&P still slightly looking good. Nasdaq looking horrible. Like, that rotation is just crazy. Say something happy today, Papa. Papa Pal. Say something exciting. I wonder... Introducing and updating. Maybe there's... Maybe he's not saying much right now. And he's at... Oh, this is 8:30 Eastern. Okay, that was today. So I don't know if it started yet. This thing would be lighting up if he was talking. He's supposed to be talking, so I don't know. Maybe there's a link on investing to watch it. Maybe it's not on televised. Is it televised? And we have a link? Let's see if it's on the Fed website. No. Well, QQQ and S&P are deviating, so it's hard to say which one. We usually lean to the fact that the S&P wins more than the Nasdaq wins. If Nasdaq looks bad and S&P looks great, S&P usually wins of the two. This is a more robust thing. So when it's down like this and this is up, one could imply that people are selling tech stocks and rotating into good other stuff that's dipped, right? And when you go looking at all the sectors today, Nasdaq, like I said, Nasdaq, they're different in that they're independently operating. Each one of them has its own thing. Nasdaq is tech, telecom, healthcare. It's missing financials, missing energy. So they're deviating like this. It's just showing you how heavy those three sectors are getting slammed. When you come look at all the other sectors, you see all the other sectors are looking great. That's why the S&P is not crashing out like QQQ likely is, right? So they're moving at different speeds. So it does imply that NASDAQ wants to go down here, but the S&P wants to go up there. So a lot of times the S&P yanks the NASDAQ around, and that's common. So when you trade that's why trading the NASDAQ is much harder, because the S&P, the NASDAQ's going to do its own thing, but the S&P likely yanks it around too. But very rarely does the NASDAQ pull the entire market down, because people, if you think about what's really going on, think of the index as actually a thing that represents all the stocks inside of it. If the sentiment overall is still very bullish, then people might be getting out of the tech and getting into other sectors that haven't rallied yet, buying the dip elsewhere. So this is what Powell's finally talking out. Do we have a link for that, anybody? So just kind of keep that in mind, is that when NASDAQ looks bad, the S&P looks good. That divergence light comes on to let you know. So the divergence light is, this is less, one of them's greater than 10, one of them's less than -10. And that divergence light comes on. It's red. It's yellow if one of those conditions isn't met, but they're away from each other by 20. This lets you know that there's sector cycling. Oh, thank you, Andrew. Oh, Andrew, always with the win. Thanks, bud. So this could hint that the market's selling off faster if tech topples first and everything else starts toppling after. So if you start to see that site, you're trying to think of the psychology of what's actually moving around. Right? Starting to speed up right now. I can just feel it. Powell's actually talking.
Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration.
People listening for signs. The question is, are we going to cut rates or not? We already determined that we're not going to raise rates. We determined that this morning.
Labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to...
So hear that? You hear Powell? Did you hear Powell say the labor demand exceeds the supply of available workers? Did y'all hear me deduce that this morning when I told you guys you learned something? Powell literally says that. You start doing things the way we teach you here, you will start to put words in Powell's mouth. Right? The demand exceeds the supply of workers, which means wages are going to come down, which means inflation's on target to lower.
Long-standing disparities.
When you do this long enough, you learn that you can predict what he's going to say, because you're reading the same data he's reading.
Over the past year, but remains above the FOMC's longer-run goal of 2%.
Cool, right?
Total personal consumption expenditures prices rose.
Matt, love the Always Do News. Every commentary, please keep doing it. Oh, thank you, Armor. Love you.
Excluding the volatile food and energy categories, core PCE prices rose 2.8%.
Powell's just reading the data, the same data that you get every week.
It was widespread across both goods.
And they do the same kind of analysis that we're doing now.
Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasts.
We already determined that the Fed is not going to raise rates. That is a given.
After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5%.
The question is,
last July,
is inflation lower enough?
Our balance sheet at a brisk pace and in a predictable manner.
Are we close enough to the 2% when they're going to cut rates?
Downward pressure on economic
Win-win.
and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Dialing back restraint.
But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
So he's telling you the pros and cons of going one way, of reducing too little or not reducing enough.
We will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
Okay, so remember CPI is like this.
Inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored.
They want to see, or whatever it is right now, but they want to see this, the cut.
Over the longer run.
They want to cut somewhere in here.
We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
They want to see inflation closer to 2%.
To achieve our maximum employment and price stability goals.
This is, you know.
Thank you, Chairman Powell.
He said we want to be confident that we're on our way to our 2%.
The U.S. Congress as Chair of the Federal Reserve, and we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none.
It's going to move before we hear the words because YouTube's got a delay.
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and and the incoming data as they affect the outlook, and those are the things we'll be looking at.
Maximum employment and price stability.
So what
JOLTS ticking up is a good idea for that. You have jobs available, and you need unemployment ticking down.
Would you point to, and do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We
need to see the PCE changes, PMIs.
Inflation has moved down more than 3 full percent.
Indicating the economy, CPIs.
We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates.
The answer is they're not going to raise rates pretty
because of the strength in the economy and the strength in the labor market.
Anytime soon that we can think of.
We can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Sometime this year.
Well, let's pivot to regulatory policy. As you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries.
So sometime this year is not super. Now, I don't know if the knee-jerk reactions to kick that down. On that doesn't really sell things off. So sometime this year, and it's only March, right? So this could be perceived as knee-jerk bearish. So that little dip, let's see what people do to that.
The general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening?
That's the main thing that people want to take away from the conversation is when we're going to cut rates. If the data's there, then sometime this year. This is what he said.
And is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right. We've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses.
He's being very light.
We had asked for very specific.
Try not to put too much hope in the market. And the reason for that is the market's trading all-time highs on its own.
We did get that.
It doesn't want to stir up a rally. So it tells me rate hikes are going to come. They just don't want to let us know. I mean, rate cuts are going to come.
But I think I can say
they just don't want to stir up frenzy right now to create some bullishness in the market. Being very, very cautious about producing information like that. This is dumb.
broad support.
I might just call it.
To Fed and in the broader.
Or trim.
As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal.
I was expecting a little more momentum. I want to see us back above hedge pressure, so I'm still play it.
If when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out. You would not rule that out at this stage of the game. Reproposal.
Not at all. No, I think
do you guys hear what I'm saying? Is that they want to cut rates. They want to do it this year. He just doesn't want to tell us right now that they're going to do it and when they're going to do it, because they want to. They don't need to do that. If the stock market was crashing, he'd be talking about right now, we're going to cut rates in one of the next couple cycles to kind of balance things out. But now markets are at high. If he says the word rate cut, we're rallying, right?
Building consensus around the substantive changes.
So he doesn't need to do that to simulate a rally.
That is right. I said
We're trying to be careful to not overstimulate the market unnecessarily.
It's more important that we get this right than that we do it fast. We understand that.
We get it right, we do it fast.
This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell.
They know a bull stock market turns into a hiring spree. But if the market goes there on its own, the Fed doesn't have to take action.
I want to talk to you about housing, but before I get there, let me address
Housing's going to be a big part of this as well.
Mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I think I do.
Got slight improvements in NASDAQ, but it's not good enough.
On what's going on with their review of merger practices.
With that 509 SPY holding, we see that fight there.
I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
We haven't even. I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the three components that we look at that make up the core PCE index, and it has been coming down from its heights of a couple years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from currently entered into leases, that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's been reported that the methodology used to assess housing costs as an indicator of inflation is imperfect. Namely, because it considers costs based on both new and old rents, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so, what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics, and you all discuss the interactivity of that rule with other rules. So if you were to repropose the Basel III endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III endgame?
There's that hedge pressure tap. Things are getting slightly better.
We haven't made the first decision.
Do I close? Do I hold a runner?
Yeah, that's a question.
$300 loss. I know it sucks to kind of be hanging on to this. Take some drawdown. I shouldn't have gone in so heavy to bet on the news, but I was betting on good news. So yeah, trying to get the so essentially Powell's saying is like things are going to look better in the economy, and they're getting better, but they're not confident yet. They've seen some confidence inflation's coming down. They're not super confident yet. It's going to get 2% on its own. Markets at highs. They're scared to say they're going to cut rates, even though they're probably going to cut rates sooner rather than later.
Seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended.
So I'm looking for SPY to return to the expected range.
The process of evaluating the comments.
To 10. Now we are testing hedge pressure. Now when I take a drawdown like this off of a catalyst event, a news event, market's going to behave irrationally. Normally, in a normal situation, I'd scalp from there to there and close it.
We want to understand the effects, make sure we understand them correctly, so that we can evaluate.
Made 2,308. Nice.
Should look like.
Good.
Fortunately, I did roll the dice and took a little bit of heat, and we're back to where we started, which means basically it's a wash. Nothing Powell's saying is surprising the market. We effectively priced it in initially.
Since President Biden was inaugurated back in January of 21, and yet in spite of that 17%,
NVIDIA is moving pretty good.
Wages have actually fallen.
Honestly, though,
So there's no doubt that inflation is the biggest issue facing American households.
I'm going to close it. I'm going to take that small loss and call it. I don't think I'm going to fight this one.
Certainly, we had supply disruptions.
I'm going to leave it.
We've had unprecedented fiscal policy.
NVIDIA, I forgot NVIDIA doesn't have much room to run.
Unsustainable. But
I'm going to stay away from this today.
The Federal Reserve, in my view, and many
I think I'll consider myself lucky just taking that one. Yes. Hey guys, look at this. Hey, breakfast. Breakfast of champions.
What I want to talk to you about is that the FOMC announced in August of 2020.
Anytime you're playing with news, it's going to be weird. I'm going to take what I can get and just say that I got lucky. Walk away from that one.
But it would give you flexibility on the 2%.
There's really nothing else I can take from here because any break from here could kind of scalp to there, and it just doesn't look clean again. I'm going to hit it hard when we get another decent setup tomorrow. Faux show.
The Fed had such challenges
baby.
in getting the price level to 2%. That was a
Hey, do me a
major
favor. It's your first time here.
growth.
Subscribe to the stream.
Do you think, in retrospect of now what we've witnessed over the past 4 years, that that was a mistake in hindsight?
Go here.
Is that framework, and is it under review?
So we said we would
Go to our Discord. Give us a follow.
on a 5-year basis, and that
I'll still be live for a little bit. I don't think I want to trade this anymore.
this year. So we really haven't
If I wasn't in a trade, I would have scooped it from there to there.
This will be one of the questions we look at. But the
So see how I drew this earlier? Isn't that cool that I drew this earlier exactly like that, and it's doing exactly that? This is what we do at Rocket Scooter. We teach you how to forecast as best as possible potential moves in the market
is always very close to the effective lower bound, so there wasn't
and use confidence at these extremities to decide if you want to hold or go or reject or whatever.
inflation expectations anchored at 2%.
How you feeling, Emilio? You feeling better, dude? How's your arm?
Really may have changed that.
That was gnarly, man.
Anyway, we don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next
There's
year.
too many variables on the table right now.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks.
I don't want to play. I don't want to gamble on this news
Thank you, Chairman
or
Powell.
this conference.
And I think I want to pick up a little bit right where we are. 2019, 2020. The entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains were disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world,
Even though you can nice little green candle broken out that said I don't want to play it.
thereafter, so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet, just about. Is that not correct?
I think that's right. Yeah.
And I think that you also recognize a mismatch between the strength of the economy, that's what we're talking about, in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high and people. So that's something else that we need to get in control. Is that not correct? And let me just ask this. Can you say that there's a connection, for example, between
I'm setting up our new Discord.
the world, like Russia's war against Ukraine and or the turmoil in the Middle East and the economic pressures that the United States feels, does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly the war in Ukraine caused commodity prices to move up.
So what happened to Ashton's showroom? So Ashton, myself, and Adam, and everybody that's working with Rocket Scooter is
that there is an urgent
separating their brands together to be independently operating on the marketplace.
everything that is in our
Ashton's still around.
to support.
He's in a new Discord with his own stuff. It's like Adam's in a new Discord. Everyone's in a new Discord, like doing their own thing.
Lower the cost of some of the commodities, bringing food prices.
We're still all working here on the marketplace, but we're becoming too big to effectively work. And like once, like I'm creating a second Discord. We're so big.
Our jurisdiction. So
This is the house of the vendors. So
on Ukraine funding.
But if we had more,
we term it, it's easier and better to have separate functions and communities. Like Rocket Suiter's Discord
that helps bring the cost down. Cost is high
is going to be
because of the disruption in
just
in the Black Sea,
based on the platform itself.
has happened because of this war. So that would help bring
Like I'm contemplating starting my own Discord for just my own trading brand.
just here in the United States.
Because right now, Rocket Suiter Discord is synonymous with like liquidity maps and hedge pressure and all the stuff that we teach you guys. But in reality, those are my tools inside of the platform. The platform is its own entity. I'm selling tools in the platform.
Is that not correct?
So I've been contemplating creating my own brand just for the funneling purposes so that the Rocket Suiter Discord itself is a Discord of just platform.
Politics with this,
And any features that are sold inside of it. Each vendor is going to have their own tools inside of it.
that we had to go
So
do what we did
the idea is that, you know, being a marketplace with multiple vendors on it,
was save
the team is sort of independently going to operate inside of that ecosystem.
Now we are recovering
That makes sense.
and better than any other country on this planet as a result of your policies and the
You have to think, people are going to join the Rocket Suiter Discord going forward, might be buying something from one of hundreds of vendors, right?
Chairman Powell, thank you for testifying.
So them showing up and it's like me and Ash in the same Discord.
I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use.
Would be
back
like,
home.
where's everyone else? Then the question was, do we put everyone else in the same Discord
At the time, you said that was a very
and everything? So it's a better arrangement to have everybody doing their own
proposal to
thing.
even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives.
How long at 5:09?
They're among the most banks are. And
I don't know.
personally
It's hard to
very
think of
much
any trade
appreciate
ideas from here.
comments, and responses
I know that it wants to be in the expected range.
about the nature of the overall proposal.
We're in the rare range right now.
Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's
I'm trying to set up some things in this Discord. Hang tight.
we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this longstanding work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our Financial Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Basel endgame warrant a
Let's see if the monthly map still looks strong. Let's take a look.
time to appreciate their consequences.
They still look strong. They don't look bad. They don't look as strong, but as somebody has previously mentioned, in the next 1 to 3 or 4 days, it is looking possible signs of weakness. Volatility is starting to peek its head in different places. Here. The S&P moving up for a couple of days and snapping back down and holding. It just means it's going to be choppy and wide. So volatility can be there, which is this volatility we're seeing here. At the end of the day, the grander scheme of things, it's still somewhat okay. But this is implying possible selling over the long haul. And this is implying possible short squeeze. So it's weird to see, possible short squeeze, shorts increasing. So the selling pressure is looking, end of March now to start to kind of possibly be there with some volatility coming along. So the market's going to have a hard time breaking out this 5150, 5200 levels.
Are you now
by the end of the month?
Point where you believe that there will not be a recession?
So it still looks okay now. We're still trading in bullish territory with some volatility, which means dips are still going to get bought up, I think, for the next week or two, maybe the next week. But it's probably not going to have that big simulated rally. It's going to break into highs. So I have to trade with the idea of finding dips to trade back to revert to mean kind of thing. Here's a link on Financial Juice. Oh, thanks, Louis, for telling me that. I didn't see that.
What we're seeing so far this year is
Well, can't win them all. That's the first big loss on the stream, I think. What is it, $500? No big deal.
Growth at a solid pace. I will say so. There's no evidence or no reason.
Not even big. First.
Economy is in or
first day back to you from a vacation.
Recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate your saying this because we want to, at some point, eliminate the great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely. Are you of the opinion that we're headed to a soft landing, Mr. Powell?
I'll just say that what we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand. And inflation has come down sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions, and we're trying to use our policies to keep that growth going and to keep that labor market strong while also achieving further progress on inflation. That's our goal. And do I think there's a possibility we can achieve all of that while keeping the labor market strong and the economy growing? Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. You can possibly have a soft landing and miss the point at which the landing took place. How do you...
All right, guys, we're going to call it. Call in the morning. Appreciate y'all being here. We love you guys to death. And it's kind of a wash today. We're back in the expected zone. That's kind of that thing I drew earlier in the expected range. We're back to where we started. Again, illiquidity pocket. It's capped out. I did want to take the trade from here to here, from here to there. But honestly, I'm not very confident in it today.
Unemployment is pretty near 50-year
I don't think we're going to sell off, but I'm just not that confident today.
To move down closer and closer to that 2%
Be hard to-
objective, and we've made quite good progress on that over just the past year. So we want to continue those conditions, and I don't want to put the label on it. Other people can do that, but
Pal, I love you, but I'm gonna chill. All right, everybody. Thank you for tuning in. We love you all to death. Get out of here. Remember, support our community, support our drive, support our development. This 40% off a lifetime. This is this thing that we're doing that we don't ever do. 40% off is never something we've done. We want everybody that believes in our company and believes in what we do, obviously hop into that. It makes the 4,000 lifetime $2,400, and you have everything we ever make forever for free added to your platform that we make inside of it. Our tools, our indicators, our widgets, our platform. When ads come out, you won't have ads, things like that. You're gonna have all the above. Only pay for your data. So support that. That's going to help us develop and further push our marketplace out there. Like I said, we're interviewing 2 or 3 vendors a day. We're going to have the world's largest financial marketplace when we're done here, with the largest network of people. We've got 3 white label clients. We have tons of trade rooms. You have your own scripting language called Rocket Script to write your own indicators and tools. Server house, so your code stays protected. We've created things nobody's even come close to creating. We're setting the standard here, and we'll be the biggest thing in the financial industry going into 2025. Bet. Marketplace is live now, just in beta. Spot test markets, playing with it, making sure it's good. Over the next month, you will see pieces of it roll out, small announcements. You guys will serve as also a test market of the Rocket Marketplace. We'll release a few vendors to you guys just to check it out and peruse and look at it. But there's going to be a launch probably in exactly a month from now. So Kevin, you guys will get a chance being members here. Like, our lifetime community gets the ability to beta test stuff that we do. Our lifetime community will be the first people invited to participate. So just keep that in mind. Love you guys. See you later. The idea that you write your code to a server and it's broadcast to the platform, nobody does that. Every vendor in town is like, oh, I don't have to do like local license servers. I don't have to add and take away people and add people manually like I do on TradingView and NinjaTrader. And nope, you don't. Automated license server. Everything does everything on the back end. Automated roles in the Discord. Automated access to your tools. Automated entitlement to data feeds. We do it all. We built the whole thing from scratch. Our competitors will copy what we're doing for sure. We'll see y'all later.